All right, good morning, everyone. It is 8:07 on the morning of November 15th, 2022, and this is my pre-market strategy session. Today, sitting next to me, I have my 5-year-old Henry Barr, who really wants to watch his Peppa Pig episodes, so I need to make this video pretty quick. Essentially, there's been some recent good news, and that is the most recent quarterly GDP was positive as well. Inflation is coming down, and so inflation being a little bit lower than its previous month's reading and a little bit lower year over year is encouraging. That means the Fed is getting close to the end of its tightening cycle. I don't buy it. I think that the reduction in the costs of energy due to the Biden administration dipping into the Strategic Petroleum Reserve has brought down energy prices a bit, which had a rippling effect on other costs in the system. However, CPI still came in at 7.7% year over year, which is really high. And as of right now, the Fed has only tightened to 4%. So I think that there's going to be, a bear market rally is in shape because, people are feeling good with the most recent GDP and most recent CPI. I think CPI continues to stay high. I think inflation continues to stay high. And I think if energy prices go up again, the Biden administration is going to stop dipping into petroleum reserves now that the midterms are over with. And energy prices ought to start climbing back up again. And when they do, that's going to have inflationary effects on everything. Everything, gets shipped and trucked and packaged and moved and so on and so on and so on. And so, essentially, I think we are looking at a bear market rally, but then by the time the next quarterly CPI comes out, it's going to be disappointing. And the month-over-month numbers, too. I think basically you're going to start, there might be a couple of months, 2 or 3 months where it lags, but then it's going to pick back up again. And it's going to be a drag on the economy. And as rates go up, also, the U.S. economy is going to suffer. That's that much more that we have to pay out of our budget, our annual budget, toward interest. So things are tightening. In the meantime, though, the market can rally. So really, here's the channel. This is the basic channel that I have here. Here's a neckline to a head and shoulders reversal pattern that's playing out. The lead up to the top here was about 2 years long, and so I expect to see about a 2-year long move to the downside, maybe a little bit less time than 2 years. But right now, my target to the upside is this upward channel of resistance right here, somewhere around 300 on the Qs. So if we actually make it all the way back up to that spot again, that's a spot where I'd be very interested in starting to average into some short positions on tech. So we've got the VIX breaking down below. Here we've got, you're not supposed to chart the VIX, but here it is. We've got the support line down here on the VIX. For what it's worth, we're breaking down below it. Don't think it really means much. We're still in the low 20s. That is a chop bucket. That's not in the investable region yet. Yeah, my 5-year-old learned the word stupid. He's so handsome. He's such a handsome boy.
Where's Peppa?
I'll get Peppa Pig going very soon, I promise. I promise. Bitcoin's taking a dive. I expect to see Bitcoin. This is another head and shoulders pattern. And I expect to see Bitcoin somewhere around 13,000 by February of next year. The 10-year, 2-year is still inverted, not surprising. The 10-year, 2-year can stay inverted for quite a long time before the market actually crashes. This is the monthly chart. So back here in 90, leading up to 90, the yield curve pretty much stayed inverted for about a year and a half. Then before the dot-com bubble, it stayed inverted for a year. And then before the 2007 housing crash, it stayed inverted for 18 months. So we're going into, we are in month 5 of this inverted yield curve. So this thing could last another 13 months. inverted before we see the real big crash on the Qs. If it could be 7 months away if it's only 12 if it only stays inverted for 12 months. Next up, gold tends to do well in these environments. It looks like a Wyckoff distribution to me. Gold is supposed to perform well in what's called quad 4 economic conditions, where you have falling GDP and falling CPI, but it is not. I think this is just an anomaly. This recent run up, this is one heck of a run up, but I really think that it's probably just the next leg up for the next leg down. And the support line that I'm watching on this one is kind of thin right here. Let me make it a little bit larger. Is kind of looking for it to come back down again. Central banks apparently are buying a boatload of gold because it can be used. There's been a recent change where gold can be used as the same as money. So it's possible, there is a fundamental case. It is possible there's a fundamental case for the price of gold to remain elevated for a foreseeable amount of time. It's just this distribution right here, this whole entire pattern, this run up, peak, choppy up and down, that's a distribution pattern. That's not a consolidation pattern. So not looking too good. Let's see. So that was Bitcoin, the 10-year, 2-year spread, the VIX, Qs, and gold. It seemed like there's one other thing that I wanted to cover before I started this, but I don't remember exactly what it is. All right, everybody, good luck out there. Keep your wrists tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. I am out.